Hello, mortgage fans. So the summer's well and truly a memory now. So not outside in the garden doing this update, very much indoors under a permanent structure because it's been like a monsoon the last few days. So that's UK weather for you. 30 degrees one day, monsoon the next. What can you do? So more importantly, back into the mortgage world. Two main things I want to talk about this week. Firstly is around house prices and alarmingly some concerns around negative equity. So I just want to sort of talk about that in probably a fair bit of detail. And then the staple around financial advice is around inflation, which is very exciting if you're a boring financial advisor like me. So first thing around negative equity then. So reading some of the financial press and elsewhere sort of over the last week or so, there's been a lot of articles around negative equity, what people could do about it, what the risks are, etc. I personally think the risk of anyone suffering negative equity is very low, like really low. And I'm going to go through probably 4 or 5 points as to why I think that is the case. The first thing is, well, I suppose this is the main point really. When people look at house prices, people often do it in a very isolated way. Because if you're not a financial advisor or if you're not a property investor, you probably look at headlines. You know, I see annualised rates in the northeast of England getting up to like 20% annual rate, that sort of thing. And then people say, well, is that sustainable? It simply can't be. Well, if you look at it in isolation of 2021, probably not, but that's not how it works. And if you look at any major market in isolation, it just doesn't really work. You have to look over a much broader picture to give you a far more accurate view. So to give you a couple of stats, I'm a real geek, I'm a real bugger because I like to look at numbers and research stuff. I don't just like making noise, which is probably why our social media isn't getting as much attention. But what can you do? The main point then is let's look at house prices over a longer period. Now, the key divider for me is around 2016 for the referendum result for Brexit, which then took 5 years to then sort out. So if you look at house prices from 2016 to 2020, and this is to do with the nationwide house price calculator. So if you want to do this yourself, because also it's very regionalised, but if you go on yourself, put your properties details in, go to nationwide.co.uk/HPI, and you'll be able to see you can do this really, really easily. Now, London house prices from 2016 to 2020 went up 0.94%. They went up less than 1% in 4 years. So when you roll that forward, if you add in 2021's figures, I believe house prices have only got up 5.83% in 5 years. And again, to give it much greater context, if you look at the 5 years prior, so 2011 to 2016, so the 5 years, the same 5 year period prior to that, house prices went up 59.07%, went up 100-fold more. So if you look at things in isolation of 2020, you'll go, well, yeah, actually house prices go up. Is it a bubble? Is it going to pop? I just can't see it. The sort of pent-up demand from Brexit, we were really feeling before the pandemic hit. We actually started 2019 really, really well. So you can't really sort of gauge it on that alone. So that's really the big thing for me, is that it makes sort of good headlines, but the reality is, even if you have 10-15% worth of gains this year, in historical terms, it's still really low. So I think there's a long, long way to go before house prices start thinking about tailing off. Second point then is around lender criteria easing. So, again, go through that 5 year period from 2011 to 2016. That was still when we're getting to grips with the credit crunch. So availability of credit was still fairly limited, and it certainly wasn't anything like we saw in 2007. So you come forward again into the COVID era, where lenders tightened up really, really badly to the point where the government needed to bring in stimulus to say, well, actually bring back 95% lending, which was only announced in the budget in March. Many banks only brought out products in April, and some of the main guys only really came back into that market in May and June. So we've not even seen the impact of 95% lending on the market yet. That's going to be a real driver into the second half of the year. Also, if you had credit problems or a very complex situation, you could almost forget that at some points of COVID, and then certain points from sort of 2008 really sort of up until 2019 really. So what we're seeing, and I'm not exaggerating, week on week, we are seeing banks loosen their criteria, even brand new banks coming to the market. So if you have much greater competitiveness around lending, the thing that's going to happen is banks are going to loosen their risk profile, i.e. they're going to make it available for lending for people that probably couldn't get lending before. So again, that's something you're going to see play through the second half of next year. So again, you don't need to be Warren Buffett to figure out if you've got sort of supply up here, demand down there, it's just going to go the sort of way of house prices keep going up because more and more people want to buy. On that sort of supply and demand point, there was a report on RICS, which I mentioned last week actually, which said that the disparity between supply and demand is at a 7-year high, in that there is too much demand for the supply that's available. Now, you click into the 1st of July, and this is sort of the driver on it. Well, I think everyone's thinking, well, when the stamp duty holiday ends, house prices are going to fall. But that's just not going to happen because there's not going to be more properties suddenly available on the 1st of July. It's just not going to happen. That lack of supply is just going to be there. And also it's going to open up that debate that for the last 30 years, we haven't built the right types of property. Because demand's been so dampened through that sort of Brexit period, you've not really seen the impact of that. So again, I think that's going to be a big debate going forward again, is that house prices are going to keep going up, people are going to get priced out of the market, and we're going to have this big debate again about what we do with our housing stock because it's a real mess. Again, another sort of specific COVID impact as well is since COVID's been on set, and also a big thing around Brexit as well, international buyers just haven't been there. Obviously there's been some international investment, but what we saw, again, pre-Brexit, it's not a fraction of what it was. So now Brexit's sort of sorted. I mean, no one actually understands what it is or how it works. And now we've gone past every single deadline that we've finally got to that point. Now it's going to get, okay, well, fine. We'll actually sort of know broadly what the picture is. We know London's still going to be a safe bet. For all the reasons London is a good bet, nothing's going to particularly change around the rule of law. Greenwich Mean Time gives you the longest trading times based east and west, great education, etc., etc. You layer it all on, it's all still there. Nothing's really changed. So international demand is going to come back. We've seen, I think, about 150% increase in inquiries from people looking to get finance from abroad. And again, you're going to feel that in the second half of this year because the stamp duty holiday is really a domestic thing. That international supply has just not really been there. So that's another major factor. And then the last point really is just simple practicalities. If you do have a 95% mortgage, now let's be really generous. Let's say house prices only go up 2.5% for the rest of the year, which is way below everyone's estimates. But let's be really generous. That means that house prices need to fall by 7.5% next year just for you to be at 100%. That doesn't even take you negative. House prices would need to go down 8% to take you negative. Now, the probability that happened again is just unbelievably low. The only time we saw house price falls that big were between 2008 and 2010 off the back of the credit crunch. Now, COVID's obviously taught us that you can't predict the future and you don't know what's ahead of you. So something big could happen. It could, but it's extremely unlikely. And again, for all the factors I've just mentioned as well, we put that all back in there together. So international demand coming back, lenders loosening credit policy, just all the things we sort of talked about, supply and demand, the wrong sort of properties, all this sort of stuff. Just can't see house prices coming off that much. Now, I think with the UK as a whole, and this is something COVID has really emphasised actually, is that the UK is hugely regionally driven. So I'm primarily talking about London and the South East because 90% of our clients are in London or the South East. Now, if I'd bought a 95% property in Liverpool, would I be a tad nervous? Maybe. House prices might level off or come down a little bit, fine. Or any one of those little hotspots around the UK that gone absolutely nuts. You also then got the factor of then come September, your boss says, actually I want you in the office. This whole hybrid working thing isn't working for us, but I suspect that would be a big topic for the end of the year anyway. That's not one for now. So you've got the practical element of where house prices need to come off so much that you just can't see it. I just can't. I could be wrong. I've been wrong many times before in my life. That's one thing I'm certainly open to, but I just can't see it. And then if you really want to get sort of down to it, for house prices to go down in the long term and in real terms, we'd need to cast off capitalism. Because there's a big clue here. The Bank of England target growth at 2%. And again, you don't need to be Adam Smith to figure this one out, is that if prices are going to be more expensive tomorrow than they are today, then we buy today. If prices are not going to be any different tomorrow, or maybe even less, then you procrastinate, you don't buy. And we're a consumer economy, so there's a vested interest to keep prices moving upward, hence all the government stimulus in the market to keep lending moving and to keep house prices moving forward. And then my last note on this, which is a personal view I have, which is a bit weird admittedly, but I do believe this very intently, is that we have a very strange relationship with house prices in this country. Like, it's weird if you look at it in the other context, because house prices aren't like the stock market or Bitcoin or any financial market you can trade. The housing market's the housing market. So if you want to live in London or the southeast and house prices go up by 10%, it doesn't matter because you're going to have to pay 10% more on your next purchase. So you don't win. The only way you win is by sort of just moving home, and home is somewhere not London and the southeast. Maybe it's international, maybe it's somewhere else in the country. Yeah, in that case, maybe you win. Because if your house price goes up by 50% over the next 5-10 years, then actually you cash out and you buy somewhere smaller. Okay, cool, that works. But in no other context would that be a good thing, where you price yourself out a market. It's a very, very strange relationship. But anyway, that's a long topic for another time. I appreciate I sort of rambled on about that in sort of great depth, but and I know that the negative equity and house price falls are great clickbait, and that's the era we live in. So I apologise giving research, factualised answers to stuff, but I am a boring financial advisor by trade, so I have to do this stuff. On that note, that brings me very nicely into inflation, which is the thing that really sets financial advisors' pulses racing. This is like the hot stuff for us. This is really, really interesting. So, because it drives so much, inflation's just gone to 2.1%. As I touched earlier, the Bank of England target growth at 2%. Now, in normal times, what would happen if inflation goes above the target level? You raise interest rates, and if it falls below the target level, you lower interest rates. That's like the basic thing to do. The Bank of England base rate is at 0.1%, so you can't lower them at the moment. That's just not going to work. So it's interesting to see how that's going to play out over sort of the next